Hi, and welcome to the Chapter 11 Spreadsheet Help and Hints file. So in this video, I'm going to go over one of the two cases. You're responsible for doing both of these cases, but I'm going to go walk you through one of them so you get an idea of how to complete this. First thing you should do is read the instructions carefully. So Damon Corporation, a sports equipment manufacturer, has a machine currently in use that was originally purchased 3 years ago for $120,000. The firm depreciates the machine under the modified accelerated cost recovery schedule using a 5-year recovery period. Once removal and cleanup costs are taken into consideration, the expected net selling price for the present machine will be $70,000. Damon can buy a new machine for a net price of $160,000, including $15,000 of installation costs. The proposed machine will be depreciated under the 5-year recovery period. If the firm acquires the new machine, its working capital will change. Accounts receivable will increase by $15,000, inventory will increase by $19,000, and accounts payable will increase by $16,000. Earnings before depreciation, interest, and taxes for the present machine are expected to be $95,000 for each of the successive 5 years. For the proposed machine, the expected EBITDA for each of the next 5 years is going to be $105,000, $110,000, $120,000, $120,000, $120,000 respectively. The tax rate for this company is 40%. Okay. Now I included this table 4.2, so if you scroll down, this is the table. I should put that 4.2. So that table is included. All right. It's also in your book. It's 4.2. Okay. So Damon expects to be able to liquidate the proposed machine at the end of 5 years for $24,000. After paying for removal and cleanup costs, the present machine is expected to net $8,000 upon liquidation at the end of the same time period. Damon expects to recover its net working capital investment upon termination of the project. The firm is subject to a 40% tax rate. Okay, so those are the specifics of the problem to do. So create a spreadsheet to calculate the initial investment, step 1. And so we're creating spreadsheets similar to tables 11.1, 5, 7, and 9 in the textbook. Create the spreadsheet to prepare a depreciation schedule for both the proposed and the present machine. Both machines are depreciated in the 5-year period. We know that. And remember, the present machine has only 3 years of depreciation remaining. Okay, create a spreadsheet to calculate the operating cash flows for Damon for both the proposed and present value machine. Create a spreadsheet to calculate the relevant incremental cash flows. And create a spreadsheet to calculate the terminal cash flows associated with the project. Okay, so down here I put the data that I kind of pulled from the information above. So this is a good hint. So if you have a word problem like this, the first thing to do is make a little data table where you can put the information here. So we have the purchase price, the selling price of the existing machine, purchase price 3 years ago, and the selling price, the price of the new machine, installation costs, salvage values, working capital, the EBITDA for the present machine for 5 years, and the proposed next 5 years for the new machine. Okay, so I just copied and reorganized all the information from the word problem here. Here is my modified table. Maybe I want to make it like a table like that. All right, so I'm going to do question A. So question A, create a spreadsheet to calculate the initial value. All right, so I've already kind of put the layout down for you in the spreadsheet to help you with this. And installation cost, the cost of the new machine. So to answer this question, I'm going to have to take the cost. They give me the cost of the machine including installation costs. So I'm going to have to add the installation cost. I'm going to have to subtract out the installation cost. So you see F41 minus F42, because this is the cost of the machine by itself, and then I can put the installation cost back down here. And then the total installation I'm just going to add these two cells. So that becomes the total proposed installation. Now, after-tax proceeds from the sale of the old machine. Okay, so proceeds from the sale of the old machine. So the old machine can be sold at $70,000, and tax on the sale of the old machine. So we have to figure. So this is going to take a little work to figure this out. So to calculate this tax on the sale of the old machine, I'm going to have to come down here first and figure out a little schedule down here to figure out the tax of the old machine. So first I'm going to put in the purchase price of the old machine, which is up here, original purchase price 3 years ago. And then I'm going to have to do the depreciation for the old machine. So we were able to depreciate it for 3 years. So I'm going to take this cell and I'm going to multiply it by the percentage of depreciation for year 1. All right. And then what I'm going to do is I'm going to actually lock down this cell, and then I could kind of just pull this down, and since the depreciation is in order of these cells, it's going to calculate the depreciation for year 2 and year 3. So here I'm going to calculate a sum of these 3 cells. So this is the accumulated depreciation. Okay, so now let's calculate the book value at the end of year 3. I take the purchase price minus the depreciation. We get our book value. We get this. We'll put the selling price. So we have the selling price of the old machine from back up here. That's selling price of the existing machine. And then the recaptured depreciation. I'm going to take this minus the old machine sell price minus the book value. So this is the recaptured depreciation. And then we're going to have to pay tax on that recaptured depreciation at the 40% level. And so here's the tax rate. Okay, so this becomes my tax on recaptured depreciation. So I'm going to put that up here. And then we have so after-tax proceeds. So what we're going to do is we're going to say 70,000 minus the 14,000. This becomes our after-tax proceeds on that sale. And the net change in working capital. So to do this, we're going to have to go up to where it gives us the information. Increase in accounts receivables. So we're going to add that. I'm going to add inventory. And I'm going to subtract increase in accounts payable because it's current assets minus current liabilities. And this gives us a change in working capital of 18,000. So so the initial investment is going to be 1 minus 2 plus 3. So basically this is 1, 2, and 3. So 1 minus 2 plus 3. Okay, so this is the change. This is the initial investment. So we're spending $160,000 on the new machine. We're getting $55,000 proceeds from the sale of the old machine after we pay tax on it, and we're going to increase our net working capital by $18,000. So that's a cost. So the actual investment is only $122,000. Okay, so let's move on to the change in working capital. So actually, if to really reinforce the working capital number here, we can actually go down here and do, here's like a little schedule to make it a little bit more clear to you. I want to put in my accounts receivable as a current asset. So here's my increase in accounts receivable, increase in inventory, increase in inventory. So my total change in assets, I'm going to have to, now remember, if we remember from the cash, we're doing the statement of cash flows. If we're increasing assets, that's a deduction to cash because we're having to increase those assets. So that's going to be an increase. Now in the accounts payable, this is our liability. We get our liability of 16,000 here. So a total increase in liabilities is 16,000. So to get the change in working capital, we take our current assets minus our current liabilities, and that's our 18. And this means that we're going to have to bring $18,000 more to get this project going. So we want to include that as part of the initial investment up here. Okay. Now let's go to part B. So part B says, go back here. Create a spreadsheet to prepare the depreciation schedule for both the proposed and present machine. Both machines are depreciated on the 5-year modified accelerated cost recovery schedule. And remember, the present machine only has 3 years. So if we come down here, you will see that I have very nicely already done both depreciation schedules for you in the problem. Is that the case in both sides? Yes, that was very nice of me. So this is already completed, and this is the depreciation. So I just took the cost of the machine and I broke it out by the depreciation percentages to get the total depreciation. Now, I actually could have used that number. Let's see. There's 38 here. Where I calculated that from here, H88. Yeah, so actually basically kind of recalculating that. But it's okay. It shows you that it matches up. So let's move to Part C. Part C, create a schedule for calculating the operating cash flows for a Damon Corporation for both the proposed and present machine. All right. Okay, so here is with the proposed machine, here's with the present machine. So we want to calculate both of these because this is what's going to lead us to calculating our what we call relevant cash flows. Okay. So first box, we want to do earnings before depreciation, interest. So this number was given to us. If we scroll up here, I broke this up here, which is 100. This is the EBDIT for the proposed machine for 5 years, and working on the proposed machine. So now I can't copy this across. I think I have to. Maybe I could get 2 in here and it will understand I want to go this way. No, it doesn't. All right. So I'm just copying over for each of the years. What was year 4? Year 5. Okay, and year 6 is 0. All right. So these are so this was given to us for the earnings before depreciation, interest in the problem. Now depreciation. So depreciation we're going to pull from the depreciation that we calculate. So we have the proposed machine. So this means when it says proposed machine, this means our new machine. So we're going to fully depreciate this. So again, I'm going to pull this from each of the cells. So these are our, actually we have a year 6 here, okay. And that's why we have year 6, because the depreciation, it comes over in year 6. Okay, earnings before interest and tax. So here is this is just the calculations. So we're basically taking the earnings that includes depreciation, subtracting out depreciation, and this is our earnings before interest and tax after depreciation. And then we're gonna figure out our taxes. So we're gonna take our earnings and we're gonna multiply it by our tax rate, which we have up here. And I'm gonna actually lock down that tax rate cell. We'll see why in a minute. Okay, net profits after taxes. So we're gonna subtract the taxes out of that, and then we're gonna add back depreciation. So let's pull our depreciation down there. So if we take our depreciation and our net operating profits after taxes, this is what we call our operating cash flow. And once I have these cells set up, I can just grab the black plus and drag it across to populate all the cells. See, that's what's convenient about Excel. If you set the formulas up right, you can easily copy them across, and that's why, setting things up like this to solve homework problems will give you good advantage on the test, of course. All right, so moving forward, let's look at with the present machine. So the present machine, again, we have to get the present machine's earnings before depreciation and taxes. And we get a, let's see, where is that listed? It's up here somewhere. Okay, so I'm going to have to go back in the problem here. Okay, so the present value, the earnings before depreciation, interest, and taxes are expected to be $95,000 for each year. Okay, so that makes it easy. So I'm just going to put in I'm not going to even just put 95,000. Okay, so it's going to be the same for all the years. So we'll leave it like that. And then the depreciation, we have depreciation schedule up here that we calculated. And so for this, I could drag this across. Now, the depreciation schedule, because the depreciation is, we have a thing with vertical and horizontal, it's not so easy to copy across. So I have to do them one by one. And it's important that we create all these links, because if we actually go and change the purchase price, the sale price, everything can cascade through. So once you link everything, all the cells together, and you point it to the right locations, it's easy to, as a model, financial model, go in and change if we want to change the earnings estimates of the sale or price or different things like that. We can quickly get a new update on the cash flows. Okay, so this is just a formula where we take our earnings and we subtract the depreciation. And our taxes, again, is a formula where we just multiply by the 40%. Here, and I'm going to lock that down by hitting F4. And then this is also a formula where we take our earnings and we subtract our taxes. Going to add back our depreciation, and then our operating cash flows are going to be our earnings plus depreciation. Okay. So once I have this set up, again, I can just highlight everything, get this white cross to turn into a black plus, and pull this across, and I can easily calculate all of my information. One mistake here, though. Year 6, there is no revenue in year 6. So we have to modify that. Okay. And this looks right. All right. So now we're going to do our incremental cash flows. So what we want to list here is we want to list our proposed machine cash flow. And we want to look at it in, compared to our present machine cash flow for year 1. Okay. Nope, that is not the cash flow. This is the cash flow. Okay. And then we want to take our proposed minus our present, and this is what we call our relevant incremental cash flow. So what it means is the old machine, our cash flows would be 62, and the new machine will be 75. So this is the cash flow that really counts. This is what we're going to earn if we take the new machine, and that's what we really want to look at when we're analyzing it. Okay, so for each of these, again, because this is not in a horizontal fashion, I can't copy across. So I have to painstakingly put each cell in here. And the reason that I'm doing it one cell at a time is because if anything did change in this problem, I would be able to make the change, and I'll show you in a second. Okay. So then let me just copy this formula down. So these would be our, and I'm going to find a total here to get my total incremental cash flows. So this means that by taking on this new machine, my total additional cash flows would be $110,000 is what I'm going to get from making this investment. So I was saying before, what if we changed our estimates and we said that the proposed machine was going to be much higher. So the first, we say the first year of the proposed machine is going to be $155,000. Then that would flow through to here and to here, and it just keeps flow all the way through. That's why it's important to link up all the cells, so that way if you discover a mistake later on, you can change it and it'll flow everything through and fix everything for you. So you always want to think of that when you're doing Excel, that you're pointing to and calculating all the cells, so that when any little changes or corrections are made, it'll flow through and update everything automatically. Okay, so let's look at Part D. Part D says, create a spreadsheet to calculate the terminal cash flows associated with the project. Okay, so now let's calculate the terminal cash flows Part D. Okay, so the proceeds from the sale of the new machine. So the proceeds from the sale of the new machine. All right. Do we have that calculated somewhere up here? Let's see. Salvage value. So when it says the salvage value of the new machine after 5 years, this is what they're talking about when they're saying proceeds from the sale of the new machine. So if we actually go back all the way to the top of the problem and we look for, here's where it says able to liquidate the proposed machine at the end of 5 years at $24,000, and that's why I put that over here as far as the salvage value of the new machine. Salvage value basically means what I can get when I sell it. So down here where it asks for proceeds from the sale of the new machine, that's where I'm getting this $24,000 from. Okay, the tax on the sale of the new machine. So to calculate the tax, what we're going to look at is, I think, what am I going to look at for that? I think I want to calculate that down here. Okay, so let's see, the tax on the sale of the new asset. So we have the purchase price of the asset here, and we purchased it, and this I'm taking from F41, which is back up there, the purchase price, and then our depreciation schedule. I'm pulling this down from our depreciation schedule. If you remember that, see this depreciation schedule up here? I'm just pulling those numbers in to get a accumulated depreciation amount, and I can even let's see. By the end of year 5, this would be our accumulated depreciation. And then I would take the book value to calculate the book value of this. I would take the asset value minus the depreciation through year 5 is $8,000. And then I have the sale of the old asset, which we put up here. Recaptured depreciation. So we want to look at the recaptured depreciation is going to be the difference between what we're selling the asset for versus our the book value. So we're selling the asset at $24,000. The book value is $8,000. That means we're recapturing $16,000 of the depreciation, and that's the part we're going to pay tax on. So we're going to pay tax on that depreciation. Okay, so now that we completed that little schedule, when it says the tax on the machine, we can kind of put this in here. Okay, so the total after-tax proceeds, so we take the sales minus the taxes, so this is going to be our proceeds after tax. All right, so now let's see, proceeds from the sale of the old machine. So again, we want to see proceeds from the sale of the old machine. So let's move up here. And it says salvage value of the existing machine. So existing machine is also known as the old machine. So I'll put that in here. And then the tax on the sale of the old machine. So let's do that exercise again down here now with the old machine. I have the purchase price of the old machine. Here is the full depreciation of the old asset. And we'll say the accumulated depreciation is going to be a full $120,000. All right. So the book value of the asset at the end of year 3. Because remember, we're doing this in the third year of, sort of like the third year of the life of the asset. So what we have to do here is, even though I have all the depreciation for all the years, we're not, this hasn't been fully depreciated. So book value of the asset at the end of year 3. So we would take the value of the purchase price, and we would minus year 1, year 2, year 3, and then this would be the book value of the asset at the end of year 3. So we have the selling price of the old asset, which would be, we determined that we're going to sell it for $8,000, and then we're recapturing the depreciation. We have a negative number on the depreciation because we are selling it for less than the book value. So that means we're taking a tax loss. So if we multiply this by, we're basically going to get like a tax credit because we're selling it at a loss. The book value, it's worth $34,000 right now, but we're selling it at $8,000, which means that we're taking a $26,000 loss because we're saying it's worth 34, but the sale price is 8, so we're taking a loss. So we get a tax credit. So when we go back here, tax in the old machine, we're going to put in the credit here. So when it talks to total after tax proceeds, we're going to actually take the $8,000 and we're going to, I'm going to subtract the tax credit to get $18,000. So think of it this way, we're getting $8,000 from selling the machine and $10,000 tax credit, which is $18,000. Now, however you want to put the, make this a negative or positive number, just how you do it any way you want, just as long as the total after tax is going to be $18,000, because that's the money we're getting, $8,000 from selling the asset and then $10,000 from. Okay, so what we have here is, like I explained, the total after tax proceeds of the sale of the old machine. Now, so change in working capital, we're going to go and, apologize if I did this already, get our working capital. Okay. Now, the terminal cash flows, we're going to take the after-tax proceeds from the sale of the new machine, and we're going to subtract out the after-tax proceeds from the sale of the present machine and add the working capital. So then this gives us our new terminal cash flow. So what it's basically saying is that we're getting money from the sale of the new machine, and we want to take away from that what we would have gotten from the sale of the old machine and see the difference between the two, because that's what's incremental, that's what's relevant. We add back our change in working capital and we get a total terminal cash flows. All right. Okay. And that's how you solve this problem. So it's a lengthy problem. It covers pretty much everything from chapter 11. And so that's why I reference these additional tables in some of the problems that you could see, like table 11, 1, 5, 7, 9, because it's going to pretty much, this one problem encompasses the whole chapter. Now that we've completed the first worksheet, the Name on Corp case, now it's time for you to open up assignments, pull down this, and do the case yourself, following my instructions. You can either kind of play the video as you're moving along, or do it yourself and see if you remember how I went through the video. And once you complete this, then you're on your own to complete the NewCo Corp. And this is something you're going to have to use the information that we learned from the first worksheet and the class lectures and the homework and the class handouts to complete this on your own. And then you will pretty much have reinforced fully what we've learned in Chapter 11 and hopefully be a little bit closer to being prepared to take the exam. Okay, that's it. Thank you for your time, and I hope you found this helpful.